Everyone in the world of finance knows Warren Buffett. Who doesn't? Many are curious about how he succeeded in his investments, but really, you don't have to do anything spectacular to invest like him. In fact, a lot of new investors are taken aback by how simple the investing approach of the Oracle of Omaha is. In a nutshell, Buffett buys outstanding companies that are now trading below their inherent worth and stays in these purchases for as long as the companies continue to be excellent ones. Of course, the story is more intricate than that. Hey, welcome to Stock Market Mate. In this video, we'll delve a little more into Buffett's approach to investing. Before we get into it, subscribe to the channel and hit that notification bell to help us beat the YouTube algorithm. If you're done with that, then let's get right into it. We don't know exactly how Buffett does his investment research because a large portion of it is confidential. These are some of the most important Buffett investing principles that you can incorporate into your own investing strategies. Focus on quality. Warren Buffett doesn't invest in junk. You typically won't see him buying struggling businesses regardless of how cheap they become. More than 50 years ago, Charlie told me that it was far better to buy a wonderful business at a fair price than to buy a fair business at a wonderful price. Despite the compelling logic of his position, I have sometimes reverted to my old habit of bargain hunting, with results ranging from tolerable to terrible. Fortunately, my mistakes have usually occurred when I made smaller purchases. Our large acquisitions have generally worked out well, and in a few cases, more than well. Warren Buffett wrote in Berkshire Hathaway's annual letter 2012. The quality of the company should be considered one of the most crucial aspects when choosing stocks. A stock support from a well-known investor or its pending IPO is not sufficient criteria. It pays to keep in mind Buffett's mentor Benjamin Graham's sensible advice while investing your hard-earned cash. Investment is most intelligent when it is most businesslike. I should add that it is most successful when it is most businesslike. Buffett himself transitioned from Graham's quantitative-based investing to giving precedence to quality. Here's Charlie Munger, Buffett's partner at Berkshire, commenting on their Sea Candies investment. If Seas had asked $100,000 or more, Warren and I would have walked. That's how dumb we were. Munger's friend, Ira Marshall, said you guys are crazy. There's some things you should pay up for, like quality businesses and people. You're underestimating quality. We listened to the criticism and changed our mind. Look for a margin of safety. Buffett's investment strategy is founded on the idea that a margin of safety should be a priority. A margin of safety, put simply, is a feature of an investment that helps guard against investors losing money. There is a $2 margin of safety, for instance, if a stock trades for $10 per share but the assets of the company are actually worth $12 per share. The asset's intrinsic value should keep the company's stock price from dropping too much. Always paying less than a company's intrinsic value is Buffett's objective. He claims that a too high purchase price for the stock of an excellent company can undo the effects of a subsequent decade of favorable business developments. Don't follow the crowd. Another piece of advice from Buffett that is important for beginning investors, particularly in the age of Reddit message boards, is to avoid buying particular stocks just because everyone else is. However, you shouldn't constantly try to be the opposite and sell the stocks that everyone else is purchasing. Did you know Warren Buffett, being a close friend of Bill Gates, never owned a single Microsoft stock? That too. Microsoft has always been a growing entity, but why didn't Warren Buffett have any stake? Buffett has set a rule investing against a business if he doesn't understand it. He followed his own rules come what may. Now he is the richest investor in the world. The greatest method to invest is to completely ignore the herd and concentrate on identifying value on your own, like Buffett does. Approach your investments with a long-term mindset. Warren Buffett once said, "If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. This is one of the most significant statements about investing you can learn. Even during the time period he referred to as the financial Pearl Harbor, Buffett loyally held onto the bulk of his portfolio. He doesn't pick stocks only based on his expectation that they would appreciate in value this week, this month, or even this year. Buffett invests in stocks because he intends to hold on to the companies for the long run. He still regularly sells stocks for a number of reasons, but he treats the majority of his investments as long-term holdings. And if you can't adopt a forever mindset when it comes to your stocks, Buffett has said that the best investment most individuals can make is a set-it-and-forget-it investment like an S&P 500 index fund. Unless a company has suffered a sea change in prospects, such as impossible labor problems or product obsolescence, a long holding period will keep an investor from acting too human. Being too fearful or too greedy can cause investors to sell stocks at the bottom or buy at the peak and destroy portfolio appreciation for the long run. Don't fear market crashes and corrections. Although buying low and selling high is the obvious objective of stock investing, human nature often drives us to make the opposite decision. We feel compelled to invest our money when we witness all of our friends earning. It's also in our tendency to sell our shares as soon as a market meltdown occurs to avoid future price declines. When stock prices fall, there are possibilities to purchase at a discount, which Buffett loves. Would you panic and flee if you were in your favorite store when you saw all the prices had been reduced by 20%? Obviously not. When it rains gold, put out the bucket, not the thimble, advises Warren Buffett, who embraces discounts on his favorite companies. Don't be afraid to sell if the scenario changes. The most important thing to do if you find yourself in a hole is to stop digging, said Buffett when asked about an investment he chose to sell at a loss. When he undoubtedly hopes to own every asset he purchases forever, outlooks do shift. You might be surprised to find that Buffett invested heavily in mortgage company Freddie Mac a few decades ago. He made the decision to sell after noticing the lender's management had started to take unwarranted risks with the company's capital a few years prior to the financial crisis. When the financial crisis struck a few years later, it was evident that Buffett had made a wise choice. Learn the basics of value investing. Most people agree that Warren Buffett is the greatest value investor in the world. Value investing prioritizes purchasing investments at low prices compared to their true worth. A value investor's goal is essentially to buy $100 worth of a company's stock for less than $100, ideally much less. Value investors seek out and invest in companies with intrinsic values that are well above the enterprise values implied by the prices at which the company's stocks trade. Value investors like Buffett expect that the market will eventually recognize the full value of a currently undervalued company, resulting in an increase in the company's stock price and a profit for the value investor. Research and reflect. Buffett regularly spends long days in his office in Omaha, Nebraska, but it often surprises investors to learn that he spends the majority of his time just sitting alone and reading or not doing anything at all, as he has been quoted as saying, "I insist on a lot of time being spent, almost every day, to just sit and think." Buffett views knowledge as something that compounds over time. He believes that much of his success can be attributed to the accumulation of as much investment knowledge as possible. Avoid what you can't understand. Buffett steers clear of investments he doesn't fully comprehend. Because of this, Berkshire Hathaway's portfolio does not contain many high-growth technology companies or biotech stocks. Although they may not be poor companies or overpriced, Buffett is aware of his best stock-picking areas. One last lesson to remember is that you are not required to ignore a particular area or industry simply because Buffett does. By sticking to what you know, you can invest like Warren Buffett. That's about it for today's video. If you find the content helpful, kindly click the like and subscribe button. Also, you might want to leave a comment below. We love hearing from you. Thank you for watching, and we'll see you in the next video. If you enjoyed this video, you're going to want to watch one of these two videos right here. Enjoy!